Hello my fellow investors, and welcome back to another stock analysis video as well as earnings report. And today guys, we're going to be taking a look at one of your recommendations in the form of JXN Financial, and this one was brought up by Tony Myers a while ago. And I'm finally getting to it, but I'm also doing the earnings report when it comes to this company as well because, well, the earnings report wasn't too far ago, and it's kind of interesting, especially seeing that they are in the financial sector, and we know what that has been going on within the past couple of days. So let's actually take a look at that, as well as see the book value per share calculated to see if maybe at the current share price this is looking like a buy, or maybe with all the risk to the financial sector, specifically the banks, this may be a pass. So with that said, let's get started with this analysis. So now coming into the latest quarter's earnings, they announced this on the 28th of February. EPS normalized actual came in at $5.66, beat by 78 cents. EPS gap actual was a massive miss, negative $8.48, missed by $12.71. Revenue came in at $1.6 billion, which is a beat by $185.37 million. So now let's actually take a look at these earnings report for the fourth quarter and the full year 2022. And like always guys, this will be linked in the description below. And again, please remember, the reason why I do this is because this is not financial advice. Every investment is the present value of all future cash flow. I will have all the calculators you're about to see in this video available for everybody to have. Linked is in the description below. So please have the calculators that are available for free, as well as this earnings report. Link is in the description below, so that way you guys can read it for yourselves and make your own sound financial decision. So with that said, let's get started with this report. We got over here fourth quarter highlights. Net income loss attributable to JXN Financial Inc. of negative $710 million, or $8.48 per diluted share, including the impact of non-economic hedging results under GAAP accounting. Adjusted operating earnings of $491 million, or $5.66 per diluted share, down 31% from the fourth quarter of 2021. That's kind of concerning because this $5.66 is essentially the normalized actual, which we got right here, i.e. the non-GAAP. So very, very concerning that even though it did beat analyst estimates, we are still seeing this going down quarter over quarter, at least from Q4 of 2021 to Q4 of 2022. Returned $86 million to shareholders in the fourth quarter through $38 million of share repurchases, great to see, and $48 million in dividends. And their dividend, guys, is absolutely massive. We're going to take a look at that in just one second. Fourth quarter registered index linked annuity RILA sales of $560 million, up from $108 million in the fourth quarter. Total annuity account value of $209 billion decreased 19% from the fourth quarter of 2021, driven largely by lower equity markets in 2022. When it comes to the full year, we got net income attributable to JXN was $5.7 billion, or $64.23 per diluted share, including the impact of non-economic hedging. Adjusted operating earnings was $1.4 billion, or $16.27 per diluted share. Successful first full year for RILA with sales of $1.8 billion. Full year capital return of $482 million was above the midpoint of 2022 capital returns target range of $425 million to $525 million. So they hit right smack in the middle, which is again really, really good to see. Strong capital positions at the operating company level, with a risk-based capital RBC ratio of JXN National Life Insurance Company of 544% as of year-end 2022. Cash and highly liquid securities at the holding company approximately $675 million at the end of the year, which was significantly above JXN's targeted minimum liquidity buffer. Financial leverage ratio of 18.3, below the target long-term of 20 to 25%. Honestly, all of this is looking really, really good to see, especially with everything that's been happening in the market. Now, before we actually go on any further, let me show you guys what this company actually does. For those of you who don't know, they are in the financial sector and they are in the industry for diversified financial services. They're not a bank, but they're kind of like a pseudo bank when you think about it. JXN Financials, through its subsidiaries, primarily provides a suite of annuities to retail investors in the United States. The company operates through three segments: retail annuities, institutional products, and closed life and annuity blocks. The retail annuities segment offers various retirement income and savings products, including variable, fixed index, fixed and payout annuities, as well as registered index linked annuities and lifetime income solutions. The institutional products segments provides traditional guaranteed investment contracts, funding agreements comprising agreements issued in conjunction with its participation in the United States Federal Home Loan Bank program. See, that's exactly what I'm talking about. Now, I know that's the Federal Home Loan Program. I know it's not necessarily a bank, but again, it's really, really tied to the whole. Anything involving a bank right now is just really, really like a red flag. A medium-term funding agreement backed notes. The closed life and annuity block segment offers various protection products such as whole life, universal life, variable universal life, and term life insurance products. So you can see that again, they're not necessarily a bank, but they are just I wouldn't even say a conglomerate. They just do a bunch of, I guess, yeah, as the industry says, diversified financial services. So they are a little bit more insulated from the whole current banking scenario that's currently happening. But nonetheless, though, I'm fairly certain that they do deal just like any other company, right? The banks are essentially the backbone of the economy, period. They're they control the flow of money when it comes to all other sectors. So other companies may be a little bit more insulated than this one, but this one isn't directly a bank, which is a little bit, I guess, safer, seeing that they are in the same sector. Now, let's come back to the earnings report and take a look at these 2023 announcements. First of all, they got over here, increasing first quarter 2023 dividend by nearly 13% to 62 cents per share. Really nice. And also, take a look at this, announcing a $450 million increase to the existing share repurchase authorization. Awesome. And we actually got this story over here as well. This is, for some reason, it's separate. But look over here, JXN announces 13% increase of first quarter 2023 cash dividend and $450 million increase to the share repurchase authorization. Pretty much what we just read there. So we can expect them to keep buying back shares, which is, again, really, really good to see. And when it comes to what the CEO had to say, Laura Prieskorn, she said, Jackson's fourth quarter and full year 2022 results highlight our continued momentum as we met or exceeded all of our 2022 financial targets and created value for our shareholders. We entered 2023 with a strong statutory capital position following 3 straight quarters of RBC ratio growth, robust levels of excess cash at the holding company, and reported leverage below our target long-term range, which is, again, really, really good to hear. Our healthy and profitable book of business positions us well in our long-term mission of providing financial freedom for life and gives us the confidence established $450 million to $550 million capital return target for 2023. So all of this is looking really, really solid, at least when it comes to the highlights. Again, the rest you guys could read for yourselves if you guys want to take a look at like to compare these on the 3-month ended from 2021 to 2022 and the 12-month, all that stuff. Again, this will be linked in the description below for you guys to read for yourselves. Nonetheless, this is a quick summary, or at least of the highlights of their fourth quarter and full year 2022 results. So with all of that said, guys, let's come into the book value calculator to see if at the current share price, this is looking like a buy. Now we've got the ticker symbol for JXN, a market cap of almost $3 billion. And take a look at this PE. Dear Lord, 0.55? What? Yo, that is absolutely nothing. Oh my god, I believe the last time, by the way, I've only ever done this company one other time. Last time I did this, I think they were a little bit higher actually. I think they were like, no, I think that this is, no, I think they were a little bit lower, sorry. I think they were like 0.35 or something. So, it's very, very interesting. Current share price of $35.63. Now, taking a look at this graph on the 1 year, they're down 21.2%. Year to date, they're up almost 3%. Kind of reaching the peak though at around actually, we got the peak right here, 52-week range. It is $49.60 at the highest to $23.56 at the lowest. Very, very interesting. So yeah, this is going to be quite a good one because, well, we are smack in the middle, but the PE is looking very, very tiny. They do pay out a dividend of $2.27, which is a massive yield of 6.13%, a payout ratio of 13.45, a 5-year CAGR of unknown with 1 consecutive year of dividend payment. However, let's take a look at this. Looking at the dividend history, I think I even mentioned this last time. We don't have a lot of data when it comes to this, right? We don't have the 5-year data or anything beyond that because they've only been paying this dividend ever since November 17th, 2021. So I said this in my last video that you may want to be careful for this dividend because it's not consistent. What I meant by that was, and by the way, I'm still holding true to that, What I meant by that is that we do not have enough data to say that it is consistent. Obviously, they have been consistent since they started putting out this dividend. Don't get me wrong, right? But, if you have two plots, if you have 2 points of data, does that make consistency? Not really, right? Well, what about 5? Well, I would still argue no. Well, what about 10, right? You really have to assess what kind of consistency you actually mean. And what I mean is, with 1, 2, 3, 4, 5, 6 points only that they have had a history when it comes to issuing this dividend, I would like a lot more. I would like at least 3 years of data would suffice. But again, they just started issuing this dividend in November 17, 2021. So they barely have 2. So that's what I mean by consistency. I'm not saying that they can't continue it. I'm just saying that they don't have the historical backing for me to actually be confident that they will continue it. Ex-dividend date actually passed as of March 13th. Payout date is actually going to be when you guys are seeing this video on the 23rd, and they're going to pay their dividends quarterly. Now, based off of this annual dividends per share of $2.27 and their current shares outstanding, guys, this means that they pay out $187.73 million in dividends every single year. So now coming into the fundamentals, starting with the net income, we got 5 years ago of almost $2 billion to today of $5.7 billion, increase of almost 187%. Now, here we see a couple negative numbers. 3 years ago, negative $1.6 billion, but this is perfectly understandable because of COVID, right? This is when COVID hit 3 years ago, so not surprising that they went to the negative. What isn't, however, that good to see is that 4 years ago, they went in the negative as well, negative $497 million. So what caused this, I'm not really sure, but you can see that even after COVID, they rebounded back fairly nicely, even beating the 5-year ago value. However, the one thing that really concerns me though is this big jump from 2 years ago to 1 year ago, going from 3.2 billion to 5.7 billion. That's a little bit concerning. And then on top of that, this 4 year ago value over here going negative, I'm giving this guys a 55%. Looking now at the total revenue, we see something very, very similar in the revenue as we just saw with the net income. However, we don't see any negatives. Thank goodness we don't, because that'd be kind of concerning. Now, 5 years ago, they were at $13.67 billion to today of $14.55 billion, increase of only 6%. Now, we do see that drop once again from 5 to 4 years ago. And then during COVID, they stayed low at around the same kind of point. They did go up slightly by like $100 million or so, not really a lot. And then a massive, massive jump from 3 to 2 years ago, and another massive jump from 2 to 1 year ago. So, I guess it's looking better than the net income, but I just don't really like those jumps. I'm going to give this a 60%. Looking now at the shares outstanding. Now, for some reason, guys, Seeking Alpha does not have the shares outstanding for 5 and 4 years ago. I believe I came across the same exact problem the first time I did this. So it is what it is. I mean, even last time I didn't have the current value. So it is what it is. But here's the thing though, we can see that from 3 years ago to today, a nice consistent decrease in shares. And on top of that, we just read their earnings report that they are going to continue to buy back shares at a whopping pace of $450 million. Now, I have this at 85%, but you know what, guys? I'm going to go with a lot higher. I'm going to say that because they're saying this in the earnings report, I'm not going to give them a 100%, but I will give them a 95% because, again, it's very, very close. Because again, we did see the earnings report and I think they are going to do it. So let's give them the benefit of the doubt and say 95%. Now, when it comes to the assets minus the liabilities, first of all, we can see everything's in the positive over here. They did go down from 5 to 4 years ago, but this is kind of like the trend so far, right? 5 to 4 years ago, when it came to the profit metrics, they fell down too. However, here in regards to COVID, they actually got higher when it came to the assets minus the liabilities. But as of 1 year ago, they came back down. I think mainly because this 3 and 2 year ago value were overhyped, were overinflated. I wouldn't say overhyped, but yeah, overinflated would be a better word. And you can see that the 1 year ago value is $9.15 billion. Not so far off this 5 year ago value, right? So it's not looking too bad. Average total assets, it is almost $318 billion. Average liabilities is $309 billion. Doing this difference, we get $9.1 billion. I'm giving this a 50%, but I'm going to have to backpedal here a little bit again because we just read the earnings report, and once again they said, hey, we're good, we got a ton of liquidity, so they say. I hope they do. I'm gonna take their word for it. They got a lot of liquidity. Their leveraging is significantly under what they're expecting. I think they said what, like 13% or like 18%, and they're expecting to be like 20 to 25. That's like what they want to be, but they're actually under that. So all of that stuff is good stuff. So let's actually bring this up to, let's say like an 85%. Maybe that's a little bit too much. Maybe you guys want to choose 80, but I'm going to go with 85% on this one. Now, when it comes to the overall grades, we give the income of 55%, revenue 60%, shares outstanding 95%, assets minus liabilities 85%, and this gives us a total grade of 71. I don't remember what I gave it last time. I'll probably pop it up right here while I'm editing this. So thanks, future Fatal, for putting this up, even though I know you're probably going to get mad at me by doing this. But nonetheless, though, put it up because I don't remember what I put. But 71%, though, it's really, really good. Well, I wouldn't say it's really, really good, but it's passing, right? It's passing. The main issue is this net income, and it has to do with the fact that they went negative 4 years ago. But then again, we've been seeing that all across all of this, right? The assets minus liabilities, we saw that. Revenue, we saw that. So it might just be something that happened that year, guys. Please do more research as to what happened 4 years ago that made their, well, pretty much everything go down that much. If it makes sense, if you don't think it'll happen again, then that might be a good opportunity to buy this company, seeing that is this cheap. But let's actually find out if it's really that cheap. Looking at the book value per share, guys, we can see that as of today, doing the book value per share, meaning that we take the assets minus the liabilities, and then we divide that by the current shares outstanding, which should be a lot less this year, by the end of this year, because we're going to buy back shares. Guys, their book value is estimated at $101.86. That's amazing. That's absolutely amazing, especially if you guys remember that current share price. Now, looking at the tangible book value, this takes away anything that's non-tangible. Well, we get the exact same thing, $101.86. So if we do now the current book value per share and we take the price divided by that, we get that ratio. And remember, when it comes to these kinds of companies, you want to be as close as to 1 as possible, at least if you're overvalued. If you're above 1.00 in this ratio of price divided by the book value, you are overvalued. If you are at 1, you are at value. And if you're under 1, you are essentially undervalued. And guys, doing this math, we get 0.35 as a ratio for both book value and tangible book value. Can I express that this is an amazing value for this company right now? That is insane. $101.86. That's the price that should be the company at, and the current share price is 35. Again, this is not financial advice, but if you do believe these kinds of analysis, which have no assumptions to be made to begin with, right? It's just book values and tangible book values per share, then this is looking like an all-out buy. This is looking better than Ally or even Citigroup. I'm not gonna lie right here. Like, it really is. If you guys take a look at the Citigroup ones and the Ally ones, I was saying that those are good buys. And this one, again, in accordance to these metrics, this is looking like a buy. But again, even though this does not involve any form of analysis, or I wouldn't say that, sorry, assumptions, please do your own due diligence, because I still do not know what caused that drop 4 years ago. I gave it a 71%, but for all we know, that drop may have been massive. The current situation with the banks may also affect this company a whole lot. So please, please, please do your own due diligence. Do not just follow these numbers and say, okay, great, it's a buy, and then you buy it. Please do not do that, because that is the fastest way to lose money. And the last thing I want for you guys is to lose your hard-earned money that you wake up every single day at 5 a.m. and work till like 3 or 4 to lose like that. Please do not do that. Do your own due diligence. But as it currently stands, guys, this is looking very, very good. And again, as I said at the beginning when I started doing the earnings, remember that all of these calculators that you see in all my videos are available for free. The link is in the description below. Please have them. Please use them. The reason why all of this is for free is because this is not financial advice, as I said, and every investment is the present value of all future cash flow. So again, thank you for everybody who likes, who comments, who recommends, who lurks, all that stuff. We really cannot thank you enough. And again, like, we're never going to put anything behind the paywall. I'm really against all of that kind of stuff. I really am against like paying for courses. eventually the goal would be to have my own website, have these calculators available at the website, and which you guys can just use for free. And if you guys would like to support us, obviously right now, well, you guys can donate us. I'm not going to say no if you donate us, but the best way that you guys can support us right now is to just like, subscribe, comment. It really does help. Down the line, I would eventually like to have like a store where you guys can like buy merch. You know, you guys, I want to give you something physical. I'm never just going to give you like, buy this course and then get to see the trades I'm doing. Nah, I'm not about that. If you guys want to donate in the future, we'll have merch. Or if you just want to donate without getting anything in return, we'll have a button for that too, I guess, if that's what you guys want. But again, that's like way down the line. But for now, the best way that you guys can help is just like, subscribe, comment. It really does help. So now let's take a look at this dividend, because man, a 6% yield, that is really hard to come by for starters. And number two, that price tag is looking really good. So putting in $5,725, guys, this nets you 160.69 shares, which is an annual dividends of $364.76. I actually had somebody comment in the first video I ever made of JXN saying, you saying you were going to put in $5,725 doesn't really tell you anything when it comes to dividend. Yeah, I am aware. It's more for just fun. It's, you know, it's more for just being like, hey, if you were to put in, you know, this kind of money, this is how much you would increase your annual income by. Not doing anything. It wasn't supposed to mean anything. It was just supposed to be kind of for entertainment purposes. But you can see that this is a massive yield, guys. And quarterly, this is almost $100. This is almost $100 every single quarter. That's insane. So the yield is great. The fundamentals look okay, if, again, figure out what happened 4 years ago. And their current valuation is also looking really, really good. But please, again, do not follow a yield. Please do your own due diligence. This is not financial advice. And now coming into the option chain when it comes to JXN. For starters, not a lot of expiration dates. April, May, June, September, and January of 2024. But taking a look at these puts, guys, we can see that, well, the strikes are only up to $25, at least the maximum, like the lowest you get is $25, and there's no liquidity there. But for $30 and $35, especially for the $35 one, today, as if I'm recording this, the 22nd, guys, if you would have sold a put for $35, which again, please remember, this is looking like a pretty good price to buy at. And a put for $35, if the strike hits, it's only $3,500. It's not a lot. So if you are willing to sell that put and let it expire in the money, if it does go in the money, not only are you getting a massive dividend back, on top of that, you're also getting $205 as premium for selling this put to begin with. Now, if you do have 100 shares already, you can sell the call, and unfortunately, the premiums aren't that good for this. But again, well, we saw what the company should be worth. Now, for the April ones, you know, it doesn't go above 70, but you can see that for $40, the bid is $60. Not bad. For $45 is $5. But let's actually take a look at the May ones. Let's see over here. Guys, a 35 strike on the put side would be $220 in premium. And if you have the 100 shares already, you could sell the call and get $100 back. Now, what I'm curious for is this January 24th one, because I was really, well, I just wanted to see what you would get when it comes to the strikes to see if it would actually go to $100. But the fact that it doesn't do that, and I'm going to check all the other ones. Yeah, the maximum that goes to is like 70 strikes. So it is what it is, unfortunately. I really wish I could sell like a put for like, or sorry, I could sell like a covered call for like $100. That would be great. Even if like there is no premium at all. If you were to get like 100 shares of this thing and then manage to sell a covered call in the money, and then it actually goes in the money by expiration for $100 strike, bro, you were making so much money then. Oh my god, it'd be crazy. But it only goes up to like $70, so it is what it is. Nonetheless, though, again, because it is in a good value position when it comes to the book value per share and the tangible book value per share, this might be one that if you do sell a put, you might be willing to do the wheel strategy after that. All in all, thank you so much, Tony, for the recommendation of JXN. Sorry that it took so long, like always, guys. I'm going to try my best to do something new from now on, starting, well, when you guys see this today. I'm going to try to do, guys, 2 videos for you guys every single day. So total, you're going to get 3 videos per day. One from Mike and then one from me at noon, and then one from me again at 4. Basically, the one at noon, I want to cover any earnings that I may want to cover. And then the 4 one, the one at 4, it would be your recommendation, right? So that's kind of how I want to do it. Maybe the other way around. Maybe at 12, I'll do your recommendation, and then at 4, it'll be the earnings that just came out or something along those lines. But I do want to start making for you guys 3 videos a day. And that's going to be rough, but it is what it is. The more content I can provide for you guys, the better it is for the company as a whole. And you guys win because you guys get free content. But anyways, that pretty much is it for this video. Like if you like, comment, subscribe. It really does help out with the algorithm on YouTube. You guys can follow us on the YouTube sites. Link is in the description below. So with that said, peace out. We'll see you all in the next earnings report video.